Have you ever looked at a stock that seems incredibly cheap? I mean, it's truly rock bottom price compared to its earnings, its assets, and you get that flicker of excitement thinking, this is it, the bargain of a lifetime.
Oh, yeah, that moment.
Only to watch it keep falling and falling and falling. That sinking, gut-wrenching feeling when you realize you weren't picking up a hidden gem, but stepping right into a financial money pit.
Mm-hmm.
That feeling, that scenario, is exactly what we are diving into today.
That feeling is intensely frustrating, and it's the classic setup for what we call a value trap. It looks like an opportunity, but it's actually a problem in disguise.
Exactly. Today, we're taking a deep dive into the concept of value traps in the U.S. stock market, specifically. Understanding when a stock that looks attractively priced based on simple metrics isn't a bargain at all, but a genuinely bad investment.
And this deep dive is built on a stack of fascinating sources. You've shared articles from reputable investing sites, insights from seasoned financial journalists, and some really candid discussions from online investor communities, too.
Yeah.
They offer different perspectives on how investors get lured in, the specific warning signs to watch out for, and crucially, how to avoid falling into these traps yourself.
Our mission, then, is to unpack these sources, cut through the noise, and give you the tools to confidently distinguish between a true value investment, that temporarily overlooked gem that the market will eventually recognize, and a value trap.
Which, as one expert put it in the sources, is fundamentally characterized by sustained decreases in business value over time.
Yeah, we absolutely need to look beyond just the surface numbers to understand what's really going on underneath.
Okay, let's unpack this.
Yeah.
At its core, traditional value investing, championed by figures like Benjamin Graham, is about finding stocks trading below their intrinsic value, their true worth, based on their underlying business and future earnings power.
Right.
And we often initially identify candidates using seemingly cheap metrics like a low price relative to its reported earnings, its book value, or its cash flow.
It's kind of like the old cigar butt analogy Graham used, isn't it? Finding a discarded stock that's cheap enough that you might get one last profitable puff out of it before it's completely used up.
Yeah, the idea is you're buying something for less than its parts are worth, or for a minimal price, hoping for just a small return.
A quick flip, almost.
And that approach can work, but as the sources highlight, sometimes that last puff isn't just flavorless, it's toxic. This is where the critical distinction comes in, and it's a key insight from studies cited in the sources by professors like Klekonishok, Vishny, and Schleifer. They point out the difference between uncertainty and risk in value investing.
Okay, uncertainty versus risk.
Yeah.
How does that play out with value stocks? Because they seem risky.
Well, the outcomes for individual value stocks can be highly uncertain. When you buy a deeply discounted stock, you just don't know for sure if this specific company will successfully turn around, get acquired, or simply continue to decline and eventually fail.
Right.
There's a huge range of potential outcomes for any single position.
That makes intuitive sense. You're dealing with companies that clearly have issues. So predicting the future for that one company is tough.
Precisely. However, what the research found is that in aggregate, when you build a diversified portfolio of these seemingly troubled, cheap value stocks, their price behavior can actually be less risky than growth stocks, particularly in bear markets.
Really? Less risky?
Yeah, they found that value strategies tend to perform significantly better in months where the overall market is declining.
So while any single cheap stock might fail spectacularly if you own a basket of them, the low valuation acts as a kind of relative floor during market downturns. They don't have as far to fall compared to those high-flying growth stocks that are priced for perfection.
Exactly. The aggregate picture diversifies away some of that individual company uncertainty. But, and this is the crucial part, individual business failure is a real and significant risk that diversification doesn't entirely eliminate. And this is exactly where value traps reside. They are the individual companies in that potential basket that don't turn around, that do fail, or just continue to decline.
Which is why Graham's concept of the margin of safety is so vital, isn't it?
Mm-hmm.
Buying at a price significantly below your estimate of intrinsic value isn't just about making a profit, it's a buffer.
It's your protection. It's a buffer against your analysis being wrong or against unexpected problems just popping up.
Right.
But a value trap tricks you by looking like it offers that margin of safety. It appears attractively priced using common metrics like a low price-to-earnings PE ratio or maybe a high dividend yield. But this superficial cheapness is masking fundamental, often systemic problems that will cause the business value to erode over time, taking the stock price right down with it.
It lures you in with the illusion of value. And I think we can all agree it's incredibly easy to spot a value trap in hindsight. Oh, of course that stock was a trap. Look at its debt. Look at its shrinking market.
Oh yeah, hindsight is 20/20, always.
But the real challenge, the mission for this deep dive, is flagging them in advance before you commit your capital.
And that's the key. It requires digging deeper than just the surface numbers.
Okay, let's start with what is perhaps the most common pitfall, the one that lures so many investors in. Just looking at the price or overly relying on simple metrics, especially the PE ratio. The sources spend a good amount of time highlighting the dangers here.
Yeah, the PE ratio, which, stands for price to earnings ratio, essentially how much investors are willing to pay for each dollar of a company's annual earnings. It's the most widely used valuation multiple for a reason.
It seems simple.
It is simple to calculate, and compared to a more complex intrinsic value calculation, like a discounted cash flow model, a DCF, it requires fewer explicit assumptions about future growth rates or the appropriate discount rate. It seems straightforward.
But here's the crucial caveat, a point emphasized across the sources, and it's something beginner and even intermediate investors can easily miss. There is, and I'm quoting here, no basis for believing that a firm is undervalued just because it has a PE ratio less than expected growth.
Exactly. A low PE ratio alone is not a guarantee of undervaluation. Absolutely not.
So it could be low for a good reason.
Precisely. A low PE ratio can actually be perfectly consistent with a fairly valued or even overvalued firm. This is particularly true if interest rates are high, because higher interest rates mean future earnings are worth less in today's dollars, justifying a lower price multiple on current earnings.
Okay.
Or if the firm is inherently high risk or has really uncertain future prospects, the market will naturally assign a lower multiple to reflect that risk. A PE of 10 might seem cheap, but if the company's earnings are about to collapse or, disappear entirely, the 10 times earnings is still expensive. Way too expensive. One source draws a vital contrast here. They contrast PE, which is an extrinsic measure, meaning it's determined by the market's collective opinion, and something the company itself has very little direct control over.
Right, it's the market price.
With intrinsic value, which is an intrinsic measure based on the company's actual ability to generate future cash flows.
Yeah.
That's the kind of value you'd try to calculate with a DCF, looking at the business's operational reality.
And that contrast is powerful because, as another source frankly puts it, companies with low PE ratios are usually trash companies.
Wow, blunt.
Oh, yeah. They are typically value traps, not genuinely undervalued companies. The market isn't stupid, generally speaking. It typically assigns a low multiple for a good reason, reflecting underlying problems the company faces.
This really highlights the danger of simply comparing PE ratios in isolation. You can't compare the PE of a fast-growing tech company to a stable utility, or a company in the U.S. to one in an emerging market, without considering critical context.
Exactly. You absolutely need to factor in things like country-specific risk, for example. The sources mention how Russian stocks appeared incredibly cheap based purely on PE back in 2014, but that ratio completely missed the critical geopolitical and country risk context.
A massive oversight.
Huge. You also need to consider typical growth rates for the industry. High-growth companies usually trade at higher PEs. Interest rates matter. High rates tend to depress PEs across the board, and sector-specific risk factors are crucial.
So a PE of 35 could actually be cheap for a rapidly expanding, high-quality business with incredibly strong future prospects.
Potentially, yes.
While a PE of 6 could be extremely expensive for a dying company burdened with massive debt, it entirely depends on the context and, more importantly, the company's future prospects and the certainty of those prospects.
That's the key takeaway. While PE can be useful as a quick screening tool, say, identifying companies trading below their historical average PE or significantly below industry peers, it's absolutely just part of the puzzle. It's never, ever enough on its own to make an investment decision.
Okay, so if PE isn't the magic bullet, what other numbers or metrics should we look at or maybe be wary of?
Well, the sources advocate looking at other ratios, but with a preference for those that are harder to manipulate. Cash flow ratios, like price to cash flow, are often preferred over PE because generating actual cash is much harder to, let's say, manage or smooth out compared to reporting accounting earnings.
That makes sense. Accounting rules offer more flexibility, more wiggle room for when you recognize revenue or expenses, but cash is cash. Cold, hard cash.
Right. The cash flow statement tells a more grounded story, usually, and you absolutely must scrutinize the balance sheet, especially debt levels. The debt-to-equity ratio, comparing total liabilities to shareholder equity, is crucial. Excessive debt is a massive red flag.
What about the company's ability to meet its short-term bills?
Ah, that's where the current ratio comes in, comparing current assets to current liabilities. It gives you a snapshot of their short-term financial health. Alongside debt levels, it's essential. Also, keep an eye on the interest coverage ratio, that's operating income divided by interest expense. If this ratio falls below, say, 1.5 times, it means the company might genuinely struggle to pay the interest on its debt just from its core operations.
Not good.
Definitely not good.
The PEG ratio, price to earnings to growth ratio, also gets a mention in the sources as an attempt to kind of factor in growth alongside the PE.
Yes, PEG can add another dimension trying to relate price to growth, but it's still based on earnings, which, as we said, can be managed, and it requires an assumption about the company's future growth rate, which is often highly uncertain.
Right.
The core message remains: no single metric, or even a few simple ones, is a definitive answer. They are starting points for further investigation, not end points for investment decisions.
Okay, so relying just on simple metrics is a major trapdoor. Got it. What else should we be looking for? The sources provide a pretty comprehensive list of warning signs, the specific red flags that signal a potential value trap. Let's dive deep into those.
Yeah, this is where the real work begins, understanding the qualitative aspects and the underlying business reality. We can group these red flags into several categories. First, let's look at fundamental business and industry issues.
Okay, what kind of problems with the core business itself signal a trap?
Well, think about companies that are overly cyclical, prone to boom and bust cycles, or those overly dependent on a single product or service. If that cycle turns down sharply or that one product suddenly becomes obsolete, the business is in deep, deep trouble.
Or maybe the business model itself is just fundamentally broken or outdated, like it just doesn't work anymore.
Absolutely. Serving a market that is shrinking or maybe no longer exists is a classic trap sign. Or facing unsustainable pricing pressure due to intense competition or new, cheaper substitutes. The sources give concrete examples. Traditional brick-and-mortar retail really struggling against e-commerce giants like Macy's or Kohl's, or brick-and-mortar pharmacies like Walgreen Boots Alliance facing pressure from pharmacy benefit managers, the PBMs who negotiate drug prices.
Yeah, huge pressure there.
Even tobacco companies like Altria or British American Tobacco are grappling with government policy and changing social attitudes pushing against their core product.
And looking further out, even seemingly stable sectors like oil and gas infrastructure could face long-term risk from climate change initiatives or government policies that could render significant assets less valuable or even stranded. A big future risk.
Definitely. Another type of fundamental trap is simply being in a dying industry, one facing a long, slow, terminal decline. Investors might see the writing on the wall, but the perpetually low price keeps luring them in. Print media is a prime example.
Like the case of Andhra Paper mentioned in one source, it's in the writing and printing paper industry, a sector undeniably shrinking due to digitalization.
Right.
The low PE ratio isn't a sign that the market is missing something. It's accurately reflecting that declining demand, even if the company still has good return on capital employed, or ROCE, which measures how efficiently a company is using its capital to generate profits. The profitability on existing assets might be okay for now.
But the market for what those assets produce is shrinking.
Exactly. The low valuation is the market's way of telling you it understands the long-term prognosis.
Yeah.
Another critical red flag is excessive or bad debt. Leverage is a double-edged sword. It can amplify gains when things go well, but it brutally magnifies losses when things go south.
Yeah, a company with minimal or no debt is highly unlikely to go bankrupt unless something truly catastrophic occurs. But excessive debt can sink even a fundamentally decent business if it hits a rough patch. Multiple sources highlight high debt levels as a critical warning sign. You need to look for debt-to-equity ratios significantly above industry averages, say. Exceeding 2.0 in a non-financial business could be a starting point to worry. Other red flags include rising short-term borrowings, which might signal liquidity problems, or consistently low interest coverage ratios, as we discussed earlier. Less than 1.5x is a worry.
And high debt is especially dangerous when a company is already facing declining revenues or shrinking profit margins, right?
Oh, absolutely. It drastically reduces their financial flexibility. They can't easily invest in new products, cut prices to compete, or even just survive a prolonged downturn because all their cash flow is going towards servicing that debt.
They're trapped by the debt.
Exactly. Think about the Blockbuster example mentioned in one source. They were acquired with significant debt. While they were a cash cow for a time, that debt load made it much harder for them to pivot and compete with Netflix's leaner, debt-free, and fundamentally different model when the industry shifted to streaming.
Too slow, too much debt.
Jet Airways also faced this issue. Heavy debt, combined with shrinking market share and falling margins against leaner competitors like Indigo, led to its eventual collapse. PNC Infratech and Amara Raja are mentioned with debt considerations. PNC seeing an increase alongside growth, which needs monitoring, and Amara Raja taking on debt for a new venture, a key test of their financial resilience.
Shrinking market share and failure to adapt to competitive threats are also major red flags mentioned. Sometimes investors overestimate the staying power of established market leaders and underestimate leaner, more efficient competitors.
The Jet Airways versus Indigo example is perfect again here. Jet failed to adapt to Indigo's lower-cost, more efficient model, leading to a steady decline in its market share, which investors might have initially dismissed as immaterial while focusing on other metrics.
A slow bleed.
But that market share decline is a symptom of a deeper competitive problem. Or consider Indus Towers. They have a dominant position in India's telecom infrastructure, providing cell towers. But their future is constrained by near-market saturation and telecom penetration, a slower-than-expected rollout of 5G infrastructure, the looming potential threat from satellite internet technology.
Like Starlink.
Potentially, yes. And critically, their heavy dependence on financially struggling tenants, particularly Vodafone Idea. If a major tenant collapses, it severely impacts Indus Towers.
Big concentration risk there.
Huge. Cyclical traps are another classic. Industries like commodities, steel, oil, chemicals, or heavy manufacturing are brutally cyclical. They often look most attractive based on simple metrics like PE at the top of the cycle, when profits and return on capital employed, ROCE, are peaking.
Making the valuation look incredibly cheap just when things are about to turn down.
Exactly. Like the Tata Steel example, it's a brutally cyclical business. Investors who bought in at peak valuations, seeing that low PE based on peak earnings, often experienced very poor long-term returns because they didn't account for the inevitable downturn.
They bought at the top, basically.
They did. The true test is how these companies perform throughout a full cycle, including the downturns. You need to look at normalized earnings, an estimate of average earnings over a full business cycle, not just the unsustainably high peak earnings to get a realistic picture.
So don't just look at today's PE based on peak earnings. Try to figure out what earnings would look like in an average or bad year.
Precisely. Finally, under this category, losing key partnerships or failing to keep pace with innovation that offers alternative solutions can also signal a fundamentally weakening business model, even if the current numbers still look okay on the surface.
Okay, moving beyond the core business model, there are specific financial performance red flags that require looking past just the PE ratio.
Definitely. Persistently declining revenues over a period, say 3 or more consecutive quarters, is a major warning sign. It suggests the company is struggling to sell its products or services.
Pretty fundamental.
Very. Inconsistent profits, struggles with managing costs effectively, and especially decreasing profit margins compared to competitors are also crucial indicators of operational problems.
One source points out operating margins that are 20% or more below the industry average as a significant red flag. Examples like Vidal, operating in a slow-growth, intensely competitive lubricants market, facing subdued growth and pressure. Or Navneet Education, a publishing company sensitive to changes in school curriculum, whose digital initiatives have struggled to achieve scale.
And a particularly critical area to scrutinize is poor cash flow conversion or struggles with generating real cash. A company can look profitable on the income statement due to accounting methods, but if it's not turning those reported profits into actual cash in the bank, that's a serious problem.
So what are some signs of poor cash flow? What should you look for?
Well, this could show up as rising debtor levels, meaning the company has booked revenue from sales but hasn't actually collected the cash from customers yet. That's accounts receivable piling up.
Okay.
Or a poor ratio of operating cash flow, CFO, to EBITDA, earnings before interest, taxes, depreciation, and amortization, which is often used as a proxy for operational cash generation. Stretched payables, meaning they are delaying paying their suppliers, or high working capital requirements, the money tied up in inventory, receivables, and payables that are draining cash despite reported profits.
So if you see profits going up, but the cash in the bank isn't increasing or maybe even decreasing, that's a major warning sign.
Absolutely. If profits are rising but cash flow isn't keeping pace, or operating cash flow is negative for 2 or more consecutive quarters, or operating cash flow is consistently falling below net income by, say, 20% or more, or cash flow margins are significantly below industry peers, like 15% below these, are serious red flags. The PNC Infratech example, though potentially a buy for some according to the source, does exhibit inconsistent cash flows, which is somewhat inherent in the infrastructure project business, but still needs careful monitoring.
Dividend issues can also be deceptive, can't they? A high dividend yield might look attractive.
Very attractive. But it could be a trap sign if the company is paying out more cash in dividends than it's generating in free cash flow. That's the cash left over after paying for operating expenses and capital expenditures.
The cash they actually have to spend.
Right. A dividend payout ratio exceeding 80% of free cash flow is a threshold mentioned as a potential warning. Stocks like BPCL, Vitol, or Andhra Paper might offer seemingly high yields, but you have to ask if that payout is sustainable if it's not backed by sufficient free cash flow.
You need the cash to back the dividend.
You do. Amara Raja, despite having healthy existing free cash flow, noted it wasn't enough to fund their ambitious new lithium-ion investment, necessitating taking on debt which increases risk. Navneet Education's modest payouts, despite cash reserves, is less alarming in this regard, but the source notes it indicates cautious management.
What about other balance sheet or asset quality issues? Are there other things lurking there?
Yeah, working capital problems, as we touched on, like inventory levels consistently growing faster than sales, maybe 15% or more faster, or accounts receivable growing faster than revenue, 10% or more faster, can indicate problems with sales, inventory management, or collections.
Stuff piling up?
Exactly. Deteriorating asset quality can manifest as significant goodwill write-downs, writing off intangible assets on the balance sheet, which might exceed 10% of total assets, or rising accounts receivable aging, meaning customers are taking longer and longer to pay, especially beyond 90 days.
And the company's equity position itself can signal trouble. If the book value per share, the value of the company's assets minus its liabilities, divided by the number of shares, is declining for 3 or more consecutive quarters, the core value eroding.
Right. Finally, consistently low return on equity, ROE, net income divided by shareholders' equity, measuring how much profit a company generates with shareholders' money falling below 10% for 2 or more consecutive years, is a concern. Even more crucial is low return on invested capital, ROIC, measuring how effectively the company is using all its capital, debt, and equity to generate profits.
ROIC seems really important.
It's a key screening tool. Anything below 10% might be dead money because the company likely isn't earning more than its cost of capital, or WACC, the weighted average cost of capital. If ROIC is consistently below WACC, the company isn't creating value, it's actually destroying it. Airlines like Delta investing at low returns on capital is an example of this issue cited.
So those are the business and financial red flags. But even a decent business can be run into the ground by bad management, right? Let's look at the red flags related to management and governance.
Absolutely. Critical area. Poor management practices and bad capital allocation decisions are significant warning signs. And this isn't always outright fraud. Sometimes it's just incompetence or resistance to making necessary strategic changes in a shifting market, bureaucratic inefficiency.
Just inertia.
Yeah, or excessive cash hoarding without a clear plan, or making consistently poor decisions about where and how to reinvest the company's money.
The example of many public sector undertakings, PSUs in India, mentioned in the sources fits this perfectly, doesn't it? Despite often having strong underlying assets or market positions, they suffered from inefficiency, cash hoarding, and poor reinvestment decisions for years, leading to them trading at deep discounts compared to private peers.
Exactly. Nesco, mentioned as having strong financials and assets, is noted for a conservative management approach, being slow to deploy its significant cash reserves for expansion, which has led to slowing growth despite having the potential. There's a lack of clear roadmap from leadership mentioned.
Worrying governance noises are also critical. This is anything that suggests minority shareholders might not be getting a fair deal.
Yeah, things like limited share float, meaning few shares are available for public trading, a tightly held company structure, or having a second class of stock with super voting rights that concentrate control among insiders. Questionable insider trading patterns or executive compensation structures that don't align with shareholder value creation are also red flags.
The PNC Infratech case highlights how even allegations can be a red flag. While not necessarily indicative of systemic issues, bribery allegations and a temporary bidding ban, as mentioned in the source, can tarnish a company's reputation and raise questions about oversight, even if senior executives weren't directly implicated.
Right, it raises questions. And the Extreme Imtech case study, where a massive share issue was handled so poorly the exchange struggled, points to either significant incompetence or something worse related to governance and financial red flags. It's a huge warning sign.
And one source even lists having marquee management and famous investors involved as a potential characteristic of traps. That's interesting.
Yeah, it suggests that relying on big names alone isn't enough. Due diligence on the actual business and financials is still essential. Don't just follow a guru blindly into an investment.
Makes sense. Accounting issues are another area to watch. Flawed or overly aggressive accounting practices can distort the reported numbers, making profits look better than they really are.
Definitely. Changes in accounting rules or complex fair value adjustments can also make it hard to understand the true financial health. That's why focusing on metrics less susceptible to manipulation, like cash flow, is often preferred. Cash is harder to fudge.
Lack of transparency is a huge warning sign, too. If a company's financial reports are confusing, filled with jargon, or seem intentionally obscure,
It might be because they're trying to hide problems or bamboozle investors. Transparency is generally a green flag. Complexity for its own sake or a reluctance to provide clear information are definite red flags. If you can't understand it, maybe that's the point.
and this might sound less analytical, but poor company culture or even just persistent bad gossip about the business can be more telling than you think.
It really can. High staff turnover, public management drama, a consistently bad reputation within the industry.
Yeah.
These are symptoms. As one journalist quoted put it, if people aren't happy, that's normally a big red flag.
Interesting point.
It suggests underlying problems that the board might be ignoring, and the board is supposed to be acting in shareholders' interests. Conversely, positive whispers, high employee morale, and strong employee buy-in can be signs of a fundamentally healthy, well-run business with long-term strength.
Finally, while less about the fundamentals and more about market behavior, there are some technical red flags that can sometimes align with underlying deterioration, signaling weakening investor interest. Not the core, but maybe a confirmation.
Yes, though the sources touch on this briefly. These include things like the stock price consistently printing lower highs and lower lows over time, often on declining volume, showing weakening buying pressure. Specific chart patterns like a death cross, where the 50-day moving average crosses below the 200-day moving average.
Ominous name.
It is.
Yeah.
Or a head and shoulders top pattern completing on high volume can suggest a change in trend. Breaking below key support levels with significant volume spikes is also a negative technical sign.
And indicators. Things like RSI or MACD.
Yeah, indicators like the Relative Strength Index, RSI, staying below 30 for an extended period, meaning it's consistently oversold, which sometimes isn't a buy signal but a sign of chronic weakness, a bearish MACD crossover. On balance volume, OBV declining while price is stable, suggesting money is flowing out even without a major price drop yet, or a negative rate of change, ROC, over several months can also be symptoms of a stock that's struggling and potentially a value trap.
More tools for traders maybe, but they can sometimes confirm what the fundamental analysis is telling you.
Exactly. They shouldn't be the primary reason, but they can add to the picture.
Okay, so we've covered a lot of potential warning signs. It can feel a bit overwhelming. But how do we flip this around? How do we move from just identifying potential traps to confidently distinguishing a true value investment?
Well, the sources make it clear. A true value investment has strong, defensible underlying fundamentals. It's a good business that is temporarily undervalued for some reason.
Right.
It might have identifiable catalysts for growth or price appreciation things that could unlock value. Although one source wisely notes that catalysts aren't strictly necessary if the company is simply a cash-generating machine that returns that cash to shareholders consistently.
So it's a stock that is temporarily underpriced relative to its intrinsic value, that true worth we talked about, with genuine potential for future growth, profitability, or cash generation.
Yeah, key features of a true value stock include a low price, yes, but it's low due to factors that are likely temporary and unrelated to the company's long-term viability. It should ideally have consistent or growing cash flow, a robust and sustainable business plan, quality and understandable financial statements, and importantly, a price that provides a real margin of safety below your estimate of its true worth.
Value traps, in stark contrast, face long-term, often structural challenges to their business model, industry position, or financials, and they fundamentally lack a clear, credible path to sustainable improvement or recovery. The problem is deep-seated.
And here's a crucial point emphasized in the sources. Almost every cheap stock has some issue. That's why it's cheap.
Good point.
The goal isn't to find a perfect company at a low price. Those are incredibly rare. The goal is to identify the main qualitative reason the stock is cheap, the perceived problem that the market is focused on, and then, through your thorough research, try to disprove that the main issue is as bad as the market thinks or that the company is successfully addressing it.
That's a really insightful way to frame it. Instead of just looking for red flags everywhere, you identify the biggest red flag the market sees and then see if your research can prove it wrong.
Exactly.
If you can confidently prove that the market's main concern is false, temporary, or being overcome, then it might be a good investment.
Exactly. It requires active research and a bit of a contrarian mindset. The sources even mention examples of companies initially dismissed by some as value traps that went on to become huge successes, like Microsoft, Walmart, and H&R Block in one investor's personal experience.
Wow.
And iconic names like IBM, Waste Management, Walmart, and Microsoft are cited as examples of finding great companies at cheap to fair prices over time, implying they weren't always obviously value plays, but periods existed where their quality was temporarily undervalued by the market.
There's also that fascinating, though rare, case mentioned of a true recovering value trap, a stock that actually breaks free.
Yes, it's unusual, but sometimes a stock that was genuinely stuck in a value trap can recover. This typically happened when two conditions are met. First, the valuation becomes so incredibly cheap, reaching truly distressed levels, that the potential downside is minimal.
Rock bottom prices.
Right. And second, the underlying business fundamentals actually improve significantly and demonstrably.
The Coal India example from one source illustrates this well, doesn't it? After its IPO, it struggled for years, looking like a classic value trap despite a low PE, due to inefficiencies in government control.
Yeah, fit the profile.
Well.
But post-COVID, its valuation dropped to a single-digit PE, around 6, creating a substantial margin of safety. Then, external factors dramatically improved its fundamentals. A nationwide power shortage surged demand for coal, its core product.
So extreme cheapness plus a real fundamental turnaround.
Exactly. That confluence of an incredibly depressed valuation and a genuine, significant improvement in the operating environment and fundamentals allowed it to break free of the trap narrative and deliver strong returns for a period. But it's rare.
What about companies that are just inherently very hard to value? The sources bring up NVIDIA as a prominent current example. With a market capitalization soaring into the trillions, like $3.4 trillion, and still exhibiting breathtaking growth, a 69% revenue increase in the first quarter. It's certainly not cheap on traditional metrics like its PE of 46.
Right. On the surface, a PE of 46 looks high by historical standards. It could easily turn into a value trap if, for instance, demand for its high-end chips slows down dramatically, or if competitors successfully develop viable alternatives that eat into its market share, or if geopolitical factors like trade disputes significantly impact its sales or supply chain.
Any of those scenarios could make today's price look drastically expensive in hindsight, a huge fall waiting to happen potentially.
Potentially. But the T, and this is the challenge, if that explosive growth continues, or if its profitability per chip continues to expand rapidly, the prospective PE based on future earnings could be much lower, potentially making today's high price look like a bargain years from now.
That's the billion or trillion-dollar question.
Exactly. It's precisely this high degree of uncertainty about the sustainability and magnitude of future growth that makes valuing a company like NVIDIA incredibly difficult right now. For many value investors who prioritize a significant margin of safety based on a more conservative estimate of intrinsic value, the current price simply doesn't offer that buffer against the risk that the future growth doesn't materialize as priced into the stock.
So it highlights that expensive-looking stocks can also be traps, not just cheap ones.
Absolutely. Value isn't just about a low PE.
This brings us to different approaches to investing mentioned in the sources, the idea of a quantitative farmer versus a stock-picking hunter. Sounds interesting.
Yeah, the farmers like Graham, Schloss, and the researchers like Lakonishok, Vishny, and Schleifer often used a diversified basket approach.
Mhm.
Especially with value stocks, which often highlight troubled companies, they cast a wide net using quantitative screens, essentially planting many seeds, hoping a sufficient number would grow, even if some inevitably failed.
Spreading the bets.
Right. The hunters, like Joel Greenblatt in his earlier work, or William O'Neill, more of a growth investor, sometimes advocated for a more focused portfolio, perhaps just 5/8 stocks if you had high conviction and really knew what you were doing. O'Neill famously said, diversification is a hedge for ignorance, implying if you truly understand a company, you don't need to dilute your returns by owning many others.
A more concentrated, high-conviction approach.
Yes. However, the sources also present a strong counter-argument to this idea of minimal diversification, sometimes called the 15-stock diversification myth. Financial theorist William Bernstein, cited in the sources, argued that holding only a few stocks, say 15 or fewer, risks significantly underperforming the overall market over the long term.
And why is that? Doesn't adding just a few stocks give you most of the diversification benefits in terms of reducing volatility? I thought that was the case.
It does reduce volatility significantly. One study found that adding just 4 stocks gives you 71% of the maximum volatility reduction benefits, and 15 stocks gets you 87%. So yes, for volatility. However, Bernstein's point is different. It's about returns. Market returns over long periods are disproportionately driven by a very small number of super stocks that achieve phenomenal growth, like Dell growing 550 times over a decade.
Wow, okay.
If you don't own one of those handful of companies, you are likely to lag the market severely over the long run.
And since the odds of picking one of those multi-hundred baggers are statistically very low, perhaps 1 in 6 or worse, according to Bernstein, you can only truly mitigate the risk of missing them by owning a much broader portfolio, or even the entire market through an index fund.
Exactly. Plus, holding only a few stocks, especially when dealing with potentially troubled value stocks with questionable models, is inherently very risky at the individual position level if one blows up. The consensus from the sources, including later comments from Greenblatt himself, leans towards arguing that for most individual investors, owning many stocks, perhaps 20 to 30, is much better for managing the specific risk of failure inherent in value investing.
One source suggests a practical target range of 15-20 positions, kind of a middle ground.
Yeah, a reasonable balance, perhaps.
Okay, so given all these potential pitfalls and red flags, what are the actual actionable strategies investors can use to protect themselves and avoid stepping into these value traps? What can people do?
Number one, the absolute most fundamental key overriding everything else is thorough due diligence and doing your homework. You simply cannot just glance at the metrics and make a decision. You have to dig deep.
No shortcuts.
None. Conduct thorough, fundamental analysis that goes beyond the surface numbers. Compare the company not just to the broad market, but specifically to its sector peers and direct competitors.
And critically evaluate management's plans. Are they aware of the problems? Do they have a credible plan to fix them? Are they executing on that plan effectively? Look beyond simple metrics to truly understand the long-term viability and growth potential of the actual business.
The sources provide a useful due diligence checklist framework that covers key areas. Analyzing the competitive position, looking at market share trends over 5 years, pricing power, customer concentration, barriers to entry for competitors.
Yeah.
Assessing financial health, checking debt coverage ratios, trends in operating margins, efficiency of working capital management, and the cash conversion cycle, which measures how long it takes to convert investments in inventory and other resources into cash flows from sales. Conducting industry analysis, understanding regulatory changes, potential technological disruption, supply chain vulnerabilities, and where the industry is in its cyclical pattern. And evaluating management, looking at insider buying-selling patterns, track record of capital allocation, executive compensation structure, and overall past performance. It's a lot, but it's necessary.
Diversification comes up again as a crucial protection strategy. As one source famously puts it, it's the only free lunch in investing.
You simply cannot afford to put all your eggs in one basket, especially with value stocks, which are often selected precisely because they are troubled companies where failure is a real possibility. While adding just a few stocks provides most of the volatility reduction benefits, owning many more, like 15, 20 or more, is much better for managing the specific risk that any one of your value picks could turn out to be a trap and go to zero.
And remember Bernstein's point, owning a broad basket or even the entire market helps mitigate the risk of missing those few super stocks that ultimately drive aggregate market returns. Don't want to miss the big winners.
Exactly. And crucially, diversify not just by the number of stocks, but across different sectors and potentially different geographic markets. You want to avoid a situation where all your holdings are exposed to similar macroeconomic risks, where if one industry or sector struggles, all your stocks zig down together.
Correlation matters.
Hugely. One source mentions a study showing retail investors typically own only about 4 stocks, and those stocks are often highly correlated, completely negating the benefits of diversification and leading to significant underperformance, often driven by volatility and poor behavioral decisions under pressure.
The idea of diversifying across uncorrelated strategies is also touched upon. For instance, a strategy like Piotrowski's, focusing on financially strong value companies, might be uncorrelated with a classic Graham net-net strategy, buying companies for less than their working capital.
Right, because they focus on different types of risk and opportunity. It adds another layer of diversification.
Another incredibly difficult but absolutely essential strategy is knowing when to sell and having an exit strategy before you buy. This is where psychology plays a huge role and often trips investors up, myself included sometimes.
Oh, absolutely. Studies consistently show that people tend to take profits too early, cutting their winners, and hold on to losing positions for too long, running their losers.
Guilty.
It's strongly linked to loss aversion, a well-documented psychological bias where the emotional pain of a loss is felt about twice as strongly as the pleasure of an equivalent gain. This makes selling at a loss incredibly difficult emotionally.
It really hurts.
Mechanical selling strategies like stop losses, automatically selling a stock if it falls by a certain percentage, are discussed. William O'Neill, known for growth investing, was a proponent. However, the sources note this is less clearly applicable or even advisable for value investors who are deliberately buying ignored or misunderstood companies with a long-term view and a margin of safety.
Because a value investor might see a price drop as a buying opportunity, not a reason to sell, if the thesis holds.
Exactly. A value investor expects volatility and might even welcome a price drop if their fundamental analysis remains sound. Some value investors, perhaps with a touch of arrogance born from deep research, feel that their careful analysis, preference for low leverage, and margin of safety mean they don't need stop losses. Warren Buffett famously holds stocks for decades.
But ignoring the need for an exit strategy entirely is also dangerous, isn't it? You can't just hold forever no matter what.
Definitely not. Philip Fisher, a famous growth investor, but whose guidelines are useful here, suggested selling primarily for fundamental reasons. 1, you made an error in your initial assessment of the company. 2, the company fundamentally deteriorates and no longer meets your initial investment criteria. Or 3, you find a significantly better investment opportunity elsewhere.
Makes sense.
He stressed that gut feelings, market timing fears, or small price drops are not reasons to sell, as you'll likely sell low and miss the subsequent rebound.
David Draymond, a well-known contrarian value investor focusing on low PE stocks, had a more mechanical rule, didn't he?
Yes, sell every stock once its valuation, like PE, rises to the market average, regardless of future growth prospects, and immediately reinvest in a new, contrarian, cheap play. His strategy was based on always being invested in the cheapest segment of the market. Very disciplined.
Regardless of the specific method, the point is recognizing failure is hard. Loyalty to a stock you've researched, ego about admitting you were wrong, and loss aversion makes selling at a loss incredibly difficult, even when the evidence is clear.
So having predefined guidelines or procedures for when you will dispose of your worst investments is crucial to avoid being paralyzed by emotion.
A powerful suggestion from the sources is to write down your investment thesis at the time of purchase. What are the specific, concrete reasons you are buying this stock? What metrics or events will you track to confirm or refute that thesis?
Then, you must monitor objectively how events and company performance impact that original thesis. If the thesis is materially compromised, meaning the fundamental reason you bought the stock is no longer valid, sell immediately. Do not fall into the trap of finding new reasons to hold on to a losing position just because you don't want to take the loss. That's rationalizing.
An interesting alternative to a price-based stop loss, particularly for value investors, is a stop time. Graham himself suggested selling after a 50% price rise, or when the market capitalization reached net asset value, or after 2 calendar years, whichever came first.
Yeah, a specific time limit, say 2 years, can force you to reevaluate and potentially exit investments that are just languishing, preventing capital from being tied up indefinitely in a stock that seemed cheap but isn't going anywhere. It effectively acts as a temporal stop against those slow-moving traps.
Position sizing is also a critical risk management tool mentioned. Limit individual positions to a small percentage of your total portfolio, maybe 5% as a guideline.
Right, don't bet the farm on one idea. Set sector exposure caps, perhaps 20%, to avoid overconcentration. And importantly, maintain cash reserves, maybe 10–15%, so you have dry powder to take advantage of opportunities when markets dip, or if you need to exit a position and wait for clarity.
Patience is arguably the greatest edge retail investors have over institutional money managers who are often judged on quarterly performance.
Absolutely. Real investing, especially value investing focused on long-term fundamental value being recognized, means thinking in decades, 20+ years for the magic of compound growth to truly kick in. Don't try to beat professionals at short-term trading or timing the market. Take your time, build conviction in your analysis, and invest only when something genuinely makes fundamental sense at the right price.
One source suggests a practical toe-in-the-water test, if you're intrigued but not fully convicted.
Yeah, buy a very small number of shares, maybe set up a small recurring automatic buy for a few months, and then force yourself not to look at the price for several months.
Let it percolate.
If it's significantly in the red after, say, 3 months, consider cutting the loss as a signal your initial read was off. If it's flat or in the green after 3, 6, and 9 months, it seems okay. Then evaluate after about a year to decide whether your conviction is high enough to build a full position, cut it because it's just dead money, or hold in a smaller position while you continue monitoring.
Allows modest exploration, cuts underperformers. Like that.
It helps you practice cutting losers without risking significant capital initially.
Another provocative question posed. Would you risk 25% of your entire net worth on this single investment?
Oof, that's a high bar.
It is. If your honest answer is no, then you probably shouldn't invest any meaningful amount. This isn't literal advice to risk that much, obviously, but it's a mental test to gauge your conviction level. If you don't have that kind of conviction, it's likely not a screaming buy.
And don't solely rely on your own complex Excel financial model. While modeling is important, the opportunity should ideally be so obvious, the value proposition so clear, that it doesn't need a complex, assumption-laden spreadsheet to justify it. The simpler the thesis, often the potentially more robust it is.
Finally, establish a monitoring protocol for your investments. Don't obsess over daily price movements,
Please don't.
but have weekly or monthly performance dashboards. Set price alerts for significant moves that warrant attention, conduct quarterly portfolio reviews, and specifically track key industry-specific metrics for your holdings monthly. Stay informed about your companies and the wider context impacting them.
So to bring it all together, true value investing is about finding stocks genuinely underpriced relative to their intrinsic worth and future prospects. Value traps, on the other hand, are stocks that look superficially cheap on simple metrics, but have deep-seated, often structural and long-term fundamental problems that will continue to erode their business value over time.
And simple metrics like PE are merely screening tools, not definitive buy signals. Never forget that.
The absolutely key lessons from this deep dive are non-negotiable. You must conduct thorough due diligence that goes way, way beyond just glancing at the numbers. You have to truly understand the actual business model and the industry dynamics it operates within.
Scrutinize debt levels and cash flow generation with an intensely critical eye. Cash flow doesn't lie like accounting profit sometimes can.
Diligently evaluate the quality, competence, and plans of management, and pay attention to governance red flags. Develop and stick to an exit strategy for when things go wrong or your original investment thesis is broken.
And remember the power of diversification. It truly is your only free lunch against the risk of individual failure and the indispensable edge of patience. Long game.
Don't let that seemingly low price tag excite you into making a hasty decision. Dig in. Ask the hard questions. Is that stock truly undervalued because the market is temporarily overlooking something positive or fixable, or is it cheap for a very good, very dangerous reason that indicates terminal decline?
The market will perpetually present opportunities that look like incredible bargains, but sometimes, perhaps often, the biggest discount comes attached to the biggest, most hidden, most destructive problems. Stay vigilant. Do your homework meticulously.
And trust your own reasoned analysis based on fundamentals and cash flow, not just that compellingly low number flashing on the screen.
So the final thought for you.
Yeah.
What will you look for first the next time you see a stock that seems too cheap to ignore?
Great question to ponder.
Thanks for joining us for this deep dive into value traps.
Until next time.